This is a simple introduction to the beauty of charts, the use of charts in Forex trading, as well as a simple introduction to using a moving average. What I'm showing you here is basically raw data. This is daily data for the euro dollar, US dollar. And we start here as we work our way down. Now, this is what I want to show you over here, not just the open, high, low, and the close. Here to the right, we have a column over here, which is the average. This is the simple moving average. What I want to do is count. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. This is a 10 period moving average, so it has to have at least 10 periods, 10 days in this case, of data before we get an average here. Now what happens is the close, this is an average of the close. You can have averages of open, high, low, close, or any of the derivatives of price itself. In this case, we're using close. Close is commonly used because that's where the market ended up for the day, so that all the news and everything is all digested and the world events are reflected in the closing price of whichever market we happen to be looking at that time. So now, as we move down, you can see that the average price over here is going to change. That's because it is a moving average. Now, the average itself moves as the price changes. So rather than using the first 10, as we did here, to come up with this average, we use the second 10. So the new day close is added in, and the last one drops off as long as it's 10. So we can count back up from here: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And here's where we are, right here. So we use the data from that day. So we're back down here, and this goes on and on and on and on. Let's take a look at what the moving average actually looks like on a chart and the beauty of the chart itself. Okay, now we'll take a, I'm going to scroll through here so you can, this just the raw data, open, high, low, close, very standard information here. Look at the raw data. Now, you may be able to make trading decisions based simply upon this. Some people may do it based upon information they find in the newspaper, etc. But let's take a look at a chart and the beauty of using charts. All right, let's take a look at some data here. Okay, here's the daily data, and the green line we see here is the moving average. Now, the moving average is used to visually get an idea of a trend or where the trend might happen to be going. This case, of course, the trend is up, as we can both attest to, you and I. Trend is up here. Trend rolls over. Now we start to get a downtrend. You see the prices are lower, so this, of course, makes sense. I'm just scrolling through so you can take a look at some of these, just to get an idea of what everything looks like. Moving average here, prices moving above and below the moving average. Okay, now, oftentimes, the simplest way to use a single moving average is to take the trade in the direction of the trend. So let's say, for instance, here we go. I put this arrow up here for our convenience. Say that we have this close here, and it closes above the moving average. And we may say that, okay, that's confirmation. We've had a daily close above the moving average, and we may buy on the next day's open or close depending upon what our system does. And so at this particular point, we'd be long on this bar. We come back and we get a signal here based upon this very simple system that we would sell on the next bar based upon a close below the moving average, which we have right there. We'd sell on that bar, open or closed, dependent upon the system. And we'd be back in a situation here where this would serve as a trigger where we would buy on this particular bar. Okay, and be long again. So in order to illustrate that, I've just written a simple system so that you can see firsthand what these trades would look like. Okay, this is a simple moving average system using a 10-period moving average, in this case a 10-day moving average. And in this system we basically are going to do the following. We are going to buy on the open price of the next bar, and the opening price is shown on all bars on the left hand side, and the closing price is on the right hand side. High is obvious and low is too. So this bar serves as the trigger because it closes above the moving average. This means that we buy the next bar on the open, and we are officially long here. Now conversely, this bar closed beneath the moving average. This means that we would sell the very next bar. So we'd sell here on the open, and looks like we turned around out of this at a small loss, and we've closed here on this bar above the moving average, and we bought on the open, so we've gone long here, and we continue to stay long here. We continue to stay long here. This is a nice trend up because the bars are not even necessarily that close to this moving average. It touches it right here only one particular time. And then we have our bar here signaling that the very next bar we want to sell on the open. So we'll go further up here. Okay. So you can see how all of this works. And this is a 10-period moving average. This is by no means optimized. This is also a simple stop and reverse system. And what that basically means is that once you are in a short position, say here, when a long signal comes along, when it's time to take that long, you close the short position out and you enter a long position. So stop and reverse here, stop and reverse there, stop and reverse here. And as you can see, we get chopped around with these small losses, which is why you have to know what you're doing when you're using moving averages. A lot of people, they have things to say about moving averages like they're lagging indicators or they're old-fashioned or whatever. But moving averages can be used to build a profitable trading system when it's in the hands of someone that knows how to use it. Like any tool, you use the right tool. You don't use a screwdriver to drive nails into wood, although it doesn't mean that there's something wrong with the screwdriver because it's a perfect tool. You use a hammer for that purpose. So the moving average is very, very handy in lots of different ways. Simple introduction into charts here and moving averages here, and here from what you can see, looking at the prices, the chart itself is a lot better representation of pricing and relations of prices to one another than the straight raw data that we saw in spreadsheet form before. Appreciate you taking the time to take a look at this introduction. Thank you and have a pleasant day.